Okay, so this is for illustration short exercise S6-1, and this is basically the same one that is in the PowerPoint, but I'll walk you through it again. And in this problem, we're trying to identify cost behavior. So they give you the following chart, and they give you the three different cost scenarios. You've got cost A, cost B, and cost C. It says for each of the following, so the chart shows the total cost and the cost per unit at two different volumes within the same relevant range. Based on the information, they want you to identify each cost as either fixed, variable, or mixed. So if you look at down here below, we got A, B, and C. Let's start with letter A. So we've got, here's your volumes. You've got 4,000 units and you've got 5,000 units. So notice, look at the total cost. You got 42,000 at 4,000 units, and then you got $50,000 at 5,000 units. So your initial thought would be, well, it's not fixed because the total cost did change, and that's not a characteristic of a fixed cost. So then you go to the per unit cost, where they took the 42,000 divided by 4,000, you got $10.50, and then they took the 50,000 and divided that by the 5,000 units, and they got $10. Now, of course, you can see how as the cost per unit did not change, or it did change, it didn't stay constant, and it actually went down. So what that would tell you then, it's not purely variable, because if it was a true variable cost, that per unit would have stayed the same. So therefore, this has to be a mixed cost. It must have partial fixed and partial variable contained within it. On cost B, you've got a total cost of 60 at 4,000 units. And notice in this one, the total cost is still 60 at 5,000. So right away, I'm thinking that's got to be a fixed cost because the total cost didn't change. And of course, the per unit should vary, and it's going to. So 60,000 divided by 4,000 gives you $15. And then 60,000 divided by 5,000 gives you $12. So we know that's a characteristic. That is a fixed cost, because remember, under fixed cost, the per unit actually go down as volume goes up. Now, the last one, cost C, you've got 32,000 versus 40. So you notice that's looking like a variable cost. And then go to the per units. If the per units stayed the same, which they did, we know that that's going to be a variable cost. Okay, I'm going to walk you through another short exercise. This is going to be short exercise S6-2, and you're looking at a fixed cost per unit. So in this one, it says the equipment produces high quality basketballs. It says if the fixed cost per basketball is $2, again, that's per unit. If they produce 9,000, they want the fixed cost per basketball or per unit if they were to produce 18,000. Again, assume that both volumes are in the same relevant range. So your first step would want to be, what's your total fixed cost? Well, if you have $2 per unit at 9,000 basketballs, we know that's a total of $18,000. We know that would be your total fixed cost. And that would be the same total at the 18,000 basketballs. So if we took that same number and divided that by the 18,000 units produced, that's going to give you down to your fixed cost to be $1 per unit. So you essentially just reduced your fixed cost per basketball by 50% by doubling production. Okay, so on this particular exercise, I'm going to be looking at its short exercise 6-5. And if you go back and look at the PowerPoint, they would call this the account method to identify cost behavior, and I'll kind of walk you through the whys behind it as well. So again, we're trying to identify cost as either variable or fixed. And so starting with letter A, it says depreciation on equipment used to stitch the glue together. If we can assume straight line, which that's what you're going to assume, then you're going to basically say that that's going to be a fixed cost. Now, we know from financial accounting how you do have different depreciation methods, and not all methods give you the same fixed amount each period, but assume all depreciation is straight line unless stated otherwise, so that's going to be a fixed cost. Shoelaces is a direct material. Direct material, guys, are always variable. So direct material, so the more shoes you produce, the more material cost you're going to be using, so that cost is going to go up or down versus volume, so that's variable. Part C, it says patents on the process used to create the materials used in the shoe. Well, patent, what happens is you actually do what they call an amortization schedule under a patent, and that's typically also just like depreciation, so that's kind of like straight line depreciation. So therefore, patent amortization will be fixed. Letter D, rice husk filler used to make rubber like outsole. Well, again, that's a direct material or raw material. And we said again, raw materials are always variable. Part E, recycled polyester fibers used to make synthetic suede. Again, that's another raw material or direct material that will be variable. Glue would be an indirect material, but it's still part of that raw materials on letter F, so that's going to be a variable cost. And then finally, G, it says quality inspector salary. Anytime you see the word salary, think fixed, so that would be a fixed cost. Okay, so on this illustration, it's exercise S 6-6, and I'm not actually going to use this for the scatter plot. This is actually going to be used in the next exercise for the high-low method. So I'm actually going to show you how to do the high-low method. I'm not actually going to be using any of this. I'm not going to have you graph, but this is the data that we're going to use for high-low method. So assuming that our operating expenses are mixed, the way I would set this up is I have a high and I've got a low column, and I always have units as one column, and then I'm going to have the total dollars as another. So the two rows, high and low. And quite literally, all you have to do is identify, in this case, the units is going to be oil changes. So if I look for the highest number here, it looks like it's going to be 3,600. I'm going to put that right there. And then for 3,600, the cost that goes with that is $37,000. I'm going to put that with it. Looks like the low data point, pick the low number. It looks like in this case, it looks like it's going to be 2,600. So 2,600 is the low point. And at 2,600, you get 31,900. Okay, now, once you've identified that, you just have to take the difference. So 3,600 minus 2,600 gives you a difference of 1,000. And then 37,000 subtract 31,900, you're going to get a difference of $5,100 of difference. So my first step is to get the variable cost per unit. You take the 5,100 and you simply divide that by 1,000. And of course, that's going to give you $5.10 per unit. So that's your variable cost per unit. So then my second step is to go back to your equation, y equals a plus bx. Again, this is my format from the PowerPoint. And I just say pick a data point. And I always pick the high point. So let's substitute in y is your total cost. So that would be $37,000 at the high point. A is your total fixed cost plus your variable cost per unit, which is $5, multiplied by x, which is going to be 3,600. That's your oil changes at that level. So you have to multiply 510 times 3,600, subtract that from 37,000, and that's going to give you $18,640 would be your total fixed cost. So you can now rewrite the equation to say y is equal to your fixed cost total, which is $18,640, plus $5.10 multiplied by x. So we're limited. We can use this as a cost equation to predict your cost for your operating expenses based on oil changes, as long as that range is between 2,600 and 3,600 oil changes. That's our relevant range. So when you get to exercise 7, what they're going to ask you to do is to make a prediction as what if they made 34 or they performed 3,400 oil changes. So if x would be equal to 3,400 oil changes, you just have to plug that into your equation. So you get y is equal to 18,640 plus $5.10, multiply that by the 3,400, because 3,400 does fall within the range. And once you add that up, you're going to get a cost of $35,980. That would be your prediction for your operating expenses at that volume. Now, again, this is the whole answer that I just showed you right here is actually the answer to exercise S6-7, which is actually on the next slide. But all it says is basically use this data, high-low method, to get to your cost equation and then to make the prediction on 3,400 oil changes. So like I just mentioned, this is the exercise S6-7. I worked it out on the previous slide for you. And basically you're using the data from the previous exercise. And then once you get that equation, I'm going to write it out again, which was y is equal to, you've got your fixed cost of 18,640 plus 5.10x. You just have to plug in this $3,400 in for x, and that'll give you your total expected cost. Okay, so for the next one we're going to look at, it's going to be exercise S6-14, which is what they want you to do is to prepare a contribution margin income statement. So basically, remember, this is the same thing as what they call a variable costing type of income statement. It's all based on cost behavior. So it says Pamela's Quilt Shop sells homemade Amish quilts. They buy the quilts from a local Amish company at $240 each, so that's their cost. They sell them at $410. It says they also pay a sales commission of 4% of sales revenue. That's going to be a variable cost. It says they lease their country style shop for $1,600 per month. That's a fixed cost. And they pay $2,100 per month in payroll. Again, that's like a salary. So that'll be a fixed cost. And then they tell you that they sold 100 quilts. Prepare a traditional income statement and contribution margin income statement for the month. Traditional, that's what they like to refer to as what they call absorption costing, because all of the cost of goods sold, all the product costs are basically absorbed into your cost of goods sold. That's basically your GAAP type of income statement. So in the next slide, I'm going to show you the answer. We're going to use this data to again look at the variable costing and absorption costing income statements. Okay, so you'll notice again under your traditional type of income statement, I'm going to write at the top here, that is GAAP, Generally Accepted Accounting Principles. Notice you've got sales units, which was 100. The sales price, which was 410, gives you a total sales revenue of 41,000. Now, the cost of goods sold is they told you that they costed $240 was the cost to buy these quilts. So that times 100 would give you your cost of goods sold. This says they sold 100. That's 24,000. So your gross profit is basically the difference is 17,000. Now, everything else is your period cost. You've got, they said sales commissions was 4% of sales revenue. So you take that 4% multiplied by 41,000. There's your sales commissions. They told you the fixed payroll cost was 2,100. You just have to deduct that. And they also told you the lease was 1,600. So basically all these costs are essentially taken out. These are your period costs. You subtract those. These are your operating. You get net income of 11,660. So just to kind of segment these again, the 24,000, the cost of goods sold is under the traditional view. We would call that product because that's inventory, and then everything else we would say is a period cost. Now, when we look at the other one, the contribution margin, this is your variable costing. Remember, everything now is divided among fixed and variable. So because this is a merchandiser, all of their merchandise they're buying is variable. So your cost of goods sold, they spent 240. We know that's a variable cost, so that's 24,000. And the sales commissions, because it's based on a variable number of volume of 41,000, we know that's also variable. So once you combine those, that would be your total variable cost. Notice that your sales revenue is the same. That's up. Now 41,000 is still the same. So once you subtract out your variable cost, that's going to give you what is called your contribution margin, which in this case is 15,360. Everything else in the problem is given as a fixed cost. So you had payroll, which was fixed of 2,100, and you had the lease, which was fixed at 1,600. So your total fixed cost were 3,700. You subtract that, and then you get your net income. So you get the same answer here because you didn't have any inventory changes, but you can see how it's a different format. Your variable cost and contribution margin income statement splits everything between variable and fixed, whereas the GAAP absorption costing income statement splits everything between product and period types of cost. Okay, so the next one I want to show you is this is exercise S6-16, and it's still the variable costing and absorption costing income statements, but this one that's going to happen is what if inventory units change? It says inventory units increase. So it says Allen Manufacturing makes a single product. Cost, sales, and production information are given as follows. So you've got sales price of 49. You've got your variable cost, your variable product cost of direct material, direct labor, variable overhead given at $26. You've got the variable operating, which is $3 per unit sold. Fixed overhead 187,000. Fixed operating was 47. Units made during the year was 17. Units sold during the year was 13. So here we don't have the same inventory. We're going to produce, but we didn't sell everything. So you are going to have inventory. And off to the side here, just to remind you, if you can assume zero beginning, which is what you have to do in this problem, if you produced 17,000 units and you only sold 13,000, you'll know that your inventory is going to basically be 4,000 units in your ending inventory. And I'll come back to that in the next slide because we're going to need that number to reconcile the two different net incomes that we're going to get because we didn't sell everything. So we're going to set up the variable costing, the absorption costing, and then I'm going to show you how you can get that difference between the two net incomes. And the difference is always going to be, I'm just going to tell you right now, the difference will always be, in this case, it'll be the ending inventory multiplied by that fixed overhead cost per unit, which in this case, the fixed overhead is given at $187,000. You're going to have to divide that by what they produced, which was 17,000 units. That number you get there will be the number that you're going to use to reconcile any differences. So now let's take a look at the income statements. Okay, so you'll notice the first one is your variable costing. Again, you've got your unit sales price, which was $26. And of course, this is your variable, that's your variable cost per unit. That's your direct material, that's your direct labor and variable overhead. Here's your sales price was $49. They sold it 13,000 units. So here's your sales revenue, $637, and then you have to get all your variable costs. So you had variable cost of goods sold. Notice that's that variable, those are your variable product costs, $26 times the units you sold, which is 13,000. And then you had variable operating of 3 at 13,039. So you've got your variable cost. So your contribution margin is right at 260. Everything else is a fixed cost. You've got the fixed overhead of 187. You've got the fixed operating at 47. You subtract that, you get a net income of $26,000. Now, under the GAAP income statement down below, look at how this one works. You've got, again, notice they took this fixed overhead. I told you this in the previous slide. You took that number. If you divide that by 17,000 units, you get a fixed overhead cost per unit of 11. If you add that to your other variable product cost, you get a total cost to make as $37. So then here's your sales revenue. That's the same. Your cost of goods sold, I'm going to write this out. It's going to be your 13,000 units multiplied by that $37. That's going to be your cost of goods sold. You've got gross profit then at 156, and then everything else you're operating. Of course, you've got the $39,000 of variable operating plus the fixed, which was 47. So I'll just kind of make a note. That number again would be the variable that we've already calculated plus the fixed of 47. And that'll be your total total period cost essentially. You get a net income of 70. So notice in this case we have a difference between 70 and 26,000. So obviously the reason here is, I'll go back, we had produced, again, they produced 17,000 units. They only sold 13. So that would say we have 4,000 units in inventory. If you were to multiply that by this fixed overhead per unit, which is 11, okay, that's going to give you right at $44,000. And you'll note that that is the difference between the 70 and the 26. There's your $44,000 difference. And the idea is that under GAAP, you would only expense these $11 if you sold it. And because you didn't sell everything, you're actually deferring this number in inventory in your ledger, so you're not expensing it because you didn't sell it. Under the variable costing, you treated everything fixed overhead, you treated that just like a period cost. You expensed it as already. So that's basically violating GAAP per se. That's why it's different. But that's why you have the difference, is because under GAAP, you only expense product when you sell it. Because we didn't sell everything, you're going to have some deferral. So in this case, the difference here is your inventory number times that fixed overhead per unit. That will always be your difference in net income. And in future years or periods, these differences would basically offset eventually once you sold all of your inventory. Okay, so this is exercise 6-21A, and I believe this is the same one I already illustrated for you on the PowerPoint, but I'll do it once again. So we've got 3 volumes. You got 2,000, 3,500, and 5,000 garments. Their capacity, their max capacity is 5,000. So they give you some information and they want you essentially to fill in the chart. They want you to come up with the average cost. So to start with is we've got the total variable at 2,100, and what you want to do then is you're going to take the 2,100 and you're going to divide that by 3,500. Okay, so when you take that 2,100 and divide that by 3,500, that's going to give you right at 60 cents per unit. That 60 cents is your variable cost per unit. And we know that's going to be a fixed, that's essentially going to be a fixed cost per unit eventually. I'll show you how that works in a moment. When they told you that the fixed cost per garment was $2 at 3,500, you just have to take the 3,500 and multiply that by 2. That's going to give you 7,000. We know that's your total fixed cost. Okay, so there's my first column. Now that I know the rules of cost behavior, total fixed costs are fixed, so we know that 7,000 is essentially the number that you can copy across the whole board here. The same thing with variable cost per unit. We know that 60 cents is the same per unit. That's constant. And now let's go back to the 2,000 volume, and let's figure out our total variable. We've got 60 cents per unit. You just have to take the 60 cents and multiply that by the 2,000. That's going to give you 1,200. 1,200 plus 7,000 is 8,200. There's your total cost. And again, let's go ahead and total this one. That was going to be 9,100 on that second one. So then to get the fixed cost per garment, again, you just take that same fixed cost. You're going to divide that by the 2,000. And of course, that's going to give you $3.50. You add that up, you get $4.10 as your average. For the second column, again, you have that same fixed cost of 7. Divide that by, again, 3,500. And in this case, you're going to get the 2. You already got the 2. You add this together, we've got $2.60. For the last one, to get the total variable, it's going to be the 5,000. Multiply that by 60 cents. We know that's going to be right at $3,000. You add that, you get 10,000 as total cost. Your fixed cost per garment is that same 7,000, but you have to divide by the 5. So that's going to put you right at about $1.40. So your final cost, average cost, if you add those two together, will be 2. Now I know this looks kind of sloppy, but you can always go and reference it to Blackboard. I got the solution out there for you. But if you look at the bottom line, you got $4.10 to $2.60 all the way down to $2. And again, go back to the PowerPoint illustration on your lecture one. I've got all this illustrated out there as well. And it just kind of shows you that because you've got fixed cost per garment, the fixed cost per garment is not a constant. That's why you can't just use the overall average to predict cost. You have to look at the volume. Volume means everything. So variable cost per unit, yeah, those are constant, but the fixed cost does vary. And because of that, you can't just use $2 per unit at 5,000 to predict your cost at 2,000. You can clearly see how your costs are definitely different under each volume.